Hi, so today I want to cover the cost variances in management accounting. So we are saying a variance is the difference between a planned, budgeted or standard cost and the actual cost incurred. The process by which the total difference between standard and actual results is analyzed is known as variance analysis. Okay. So when actual results are better than expected results, we have a favorable variance, which is represented by an F in brackets. If actual results are worse than expected, we have an adverse variance represented by A in brackets. Okay. So just to explain what these notes mean, we are saying a variance is the difference between planned, budgeted or standard cost. They are costs which are facts, the ones we are calling standard costs, how much you are going to spend, and then these standard costs, they're the same we are calling planned or budgeted. But if the costs they do not come out as standard cost or as planned or as budgeted, that's what we are calling the actual cost, because the actual cost would differ from the standard cost, from the planned budgeted cost. Okay, so we are talking about you wanting to undertake a certain production for a particular unit, and then you are going to have the standard cost for that product, the planned cost. But when you find that after production, you find that the actual costs now, which you have incurred in the process, is either they are going to be below or they are going to be more than the standard cost, than the planned cost. Okay, so that's basically what this topic is all about. So let's quickly move forward just to also read through what I've written here, and then we'll do the calculations. So three main groups of variances. We have variable cost variance, sales variances, fixed production overhead variances. By the way, the word variance is coming from difference, okay? So direct material cost variances. Direct material cost variances, we are talking about the direct materials which goes to a product and then their variances. That's what this title is talking about, direct material cost variances, which is part of part of the variances. Okay, so now let's read here. It says the direct material total variance can be subdivided into the direct material price variance and the direct material usage variance. So the keyword here is the material variance, but there's an element of material price variance and the material usage variance. When you manufacture a certain product, you'll find that there will be the difference in the price, how much has been spent on that product in terms of material, and in terms of material usage, how much material has been used. So there's going to be those two differences which makes up the direct material cost variances. This is the whole total thing which has two in it. It has direct material price variance and the direct material usage variance. So down here we are saying direct material total variance. Direct material total variance. The total variance will be equal to difference between standard cost and the actual cost of material used or purchased. Direct material price variance equals to difference between standard cost and actual cost for the quantity used or purchased. Direct material usage variance will be equal to difference between standard quantity Direct material usage, there's nothing like amounts or what. This one is all about the quantities which have been used. So it's the difference between standard quantity of materials used and actual quantity of materials used, valued at standard cost per unit of material. Okay, I know I'm a bit quick maybe, but when it comes to calculations, you'll be able to tell what these notes actually mean.